What if a massive financial revolution happened and almost nobody noticed? Seriously. Between December 1st and 6th, 2025, India quietly pushed through some of the biggest changes to its financial system in years. Now, most people just saw a few scattered headlines. But what if I told you those headlines were all part of a single, really bold plan? Today, we're going to connect the dots. Okay, just look at this timeline. It is packed. In just 1 week, the central bank cuts interest rates, brand new rules for your bank accounts and digital apps go live, thousands of ancient regulations get thrown out, major laws are enacted, and clear signals are sent to both global investors and local startups. The sheer density of all this in such a short window is, well, it's staggering. So, how do we make sense of all of this? We're going to break it down piece by piece. We'll start with the big, headline-grabbing moves, then we'll look at the new rules that affect you, the consumer. After that, we'll tackle the massive regulatory cleanup, the subtle signals being sent to the market, and then finally, we'll put it all together to reveal the grand plan.
Right, so like I said, most of us only saw the individual news stories, a rate cut here, a new rule there, but there's a hidden strategy connecting all of them. So let's start peeling back the layers.
First up, let's talk about the headline that did grab some attention. The Reserve Bank of India, the country's central bank, basically decided to open the floodgates and make money much, much cheaper.
So, on December 5th, the RBI cut its main interest rate, the repo rate, by 25 basis points. Now, this is a big deal because it's a direct signal to banks to make borrowing cheaper for everyone, from big companies looking to expand to, families buying a new home.
But they didn't stop there. Oh no, the RBI also promised to buy a massive 1 lakh crore rupees worth of government bonds. This whole thing is called an open market operation, and it's basically like a giant injection of cash right into the banking system, making sure banks have tons of money to lend out. And for the third part of this triple whammy, they announced about $5 billion in Forex swaps. Think of it like a temporary trade. The central bank gives rupees to commercial banks and takes dollars from them, promising to swap back later. This move pumps US dollars into the system, looking sure there's plenty of cash flowing all around. So you see, this wasn't just a simple rate cut. It was a coordinated flood of money. So you might be asking, why do all of this now? Well, it's because India found itself in this rare economic sweet spot, what economists call a Goldilocks phase. You've got strong GDP growth rocketing along at 7.3%. But at the same time, you have incredibly low retail inflation, just 0.25%. This kind of perfect combination gave the RBI the confidence to hit the accelerator without worrying about the economy overheating. Okay, so while all these big economic moves were happening, something else was going on behind the scenes. The fundamental plumbing of consumer banking was getting a major upgrade, with new rules that affect you and me directly. Just take a look at this. From December 1st, that banking app on your phone, it's now treated with the same regulatory seriousness as a physical bank branch. And those vague, confusing rules about bank lockers, gone, replaced with clear liability for the bank. Even the complicated process for inheritance got simpler, letting you easily nominate up to 4 people with specific shares for your accounts. These are huge upgrades for consumer rights. And at the very heart of all this is the new Banking Laws Amendment Act. For years, if a small bank got into trouble, depositors' money could be frozen for a really long time. This new law is designed to change that. It's all about stronger protection and, crucially, faster resolution if your bank ever faces a crisis. It's about making sure your money is safer, period. All right, now for a change that absolutely did not make the evening news, but is a true silent earthquake in the world of finance and regulation.
I want you to imagine a messy filing cabinet just stuffed with over 9,000 conflicting instructions from the last 30 years. It's a total mess. That was India's regulatory landscape. On December 1st, the RBI basically set fire to that old cabinet and replaced it with just 244 clean, clear, updated master directions. This is a massive and frankly long overdue simplification.
So why does this matter so much? Because for banks, investors, and companies, navigating that rule jungle was an absolute nightmare of confusion and legal battles. This move to a clear rulebook signals to the entire world that India is getting serious about regulatory clarity and predictability. Now let's look at 2 moves that sent some powerful and, you could say, somewhat contradictory signals to both foreign investors and India's booming fintech sector. First up, the welcome mat. The market regulator, SEBI, proposed revamping the rules for foreign portfolio investors. The goal? Make it easier for global funds to register and invest. But, and this is a big but, with clear know your customer rules. The message is crystal clear. India wants foreign capital, but it has to be clean and traceable. But at the very same time, the RBI, the banking regulator, sent a warning shot. It cracked down on the popular fintech credit card OneCard because it had concerns over its data sharing practices. The signal to the startup world was unmistakable. Innovation is great, we love it, but you cannot use partnerships as a loophole to bypass core regulations, especially when it comes to customer data. So now, we have all the pieces on the table. The cheap money, the new consumer rules, the cleaner rulebook, and these dual messages to capital and tech. It's time to connect the dots and see the grand plan taking shape. And when you look at it all together, a really clear four-pillar strategy emerges. First, use cheaper money to fuel economic growth. Second, create cleaner rules to reduce confusion and make things more predictable. Third, put consumer protection right at the front and center. And fourth, encourage disciplined innovation. Welcome new ideas, but only if they operate within well-defined regulatory boundaries. And this quote just sums up the entire week perfectly. India is sending a message that it is absolutely pro-growth and pro-capital, but it's going to happen on India's terms, within a system that is robustly and heavily supervised. It's this really strategic attempt to get all the dynamism of open markets without the instability that can sometimes come with it. So what does this all mean for you? Well, as a customer, your money is safer and your digital experiences are more regulated. As an investor, the environment is being set up for growth, but on a much more stable foundation. And if you work in finance or fintech, the message is loud and clear. Innovate, but you've got to color inside the lines, because discipline is now mandatory. Which brings us to our final question. Of all these massive shifts, the flood of cheap money, that epic rulebook cleanup, or the new protections for consumers, which one do you believe will have the most profound impact on India's financial system in the long run? It's a tough choice, right? I'd love to know what you think.